Alright guys, hello and welcome to this part 4 of Module 10 where we're going to be going through how to execute profitable, missed a little L there, price ladder trades. So, we've already been through, well, I kind of highlighted in the last video, what the process behind actually executing or going through or trading these events, how would go through it. And the process, like we said before, you start off with a plan, you get your information input, and then finally you execute the trade. Now, obviously, we looked at how to optimize this. We've looked at how to potentially plan for this with some structure, which is really good. Now we've got to a stage where we can actually think about how we're going to execute the trade. And I want to highlight that in most cases, in every case, when you're trading event-driven risks or specifically central bank events, the key question that you're always asking, so the key question always asking yourself throughout the event is the market mispriced? So your whole job throughout the whole of the event or whatever you're trading, the central bank conference or a rate decision, anything that may come out, you're always asking yourself, is the market mispriced or not? And the way you can actually execute and the way you can actually go about trading this once you've figured out whether the market's mispriced or not, there's two general schools of thought. There's two schools of thought. And people tend to be in one camp or the other for some reason. I don't necessarily think it's such a black and white situation, but let's highlight more or less how people kind of trade these kind of events or execute. So you obviously have the one end, which say you should be really aggressive when you see the information. Be really aggressive, hit your big size early. And they mean basically when you hear something that you feel as if the market hasn't priced in, you've got such a thorough plan, you know exactly what you're doing, hit all of your size early and then wait for the price action. So this, you're hitting early and then wait for price action after trade, after you basically initiate trade. That's one scenario and that's one way to go about it. And a lot of traders do extremely well just by doing that every single time. They hear something, they do something, they hear something that they think is going to affect the market. They go full size market, let's say 50, 100 lots, whatever, 200 lots. And then if they go, let's say a tick or two offside, they're out straight away. And if the market has to reprice, obviously they've got a huge amount of reward to reap. The key to this, like I just said, is just like anything, if you're aggressive in, you have to be aggressive out. So important, guys. Understand this concept. If you want to be really aggressive in, and you really you want to hit all your size early and get in early, if the market starts ticking back against you and you don't see what you want to see, you don't see the price action that confirms the trade, you need to get out really quickly. Now the other school of thought, so you could be A, aggressive, or B, you could be obviously the other side of that, which is passive. And all you're doing is scaling in. You scale in as the price action confirms. Basically, you're not just getting in with all your size straight away. You're looking at the price action, waiting for that confirmation, and you're slowly scaling into your trade, putting on your sizable position. So you can afford a bigger stop on this. You can start getting in with a bit of size. You stop, let's say buying a 5 lot, and then another 5 lot, and then another 5 lot. You can afford a little bit more risk. If you go a little bit offside, then you can buy a bit more. It's a different way of trading. It's a different way of executing the trade, kind of slowly easing your way in, massaging your position until finally you feel as if the market's going to start shifting in the way that you can see it. You always have to also have very strict risk, but you can afford a little bit more with this instead of getting in full size at market. So there's two schools of thought, like I just said. In my opinion, though, I don't really think it's that, black and white. I personally think you just need to be, you should be flexible. You should be flexible, and as you trade, as you build your arsenal of different strategies, and your memory bank starts expanding from all the practice you've had over so many different events, and hopefully with these price ladder drills you can actually gain a lot more information even before you actually trade the event. um, you start building instincts, and you start building an instinct for what's going on in different scenarios, and then you can act accordingly, whether you want to be aggressive or passive. But generally, I would say if I had to say when to use an aggressive and when to use a passive approach, the aggressive method usually is when the market hasn't priced in information, and then it receives information and it needs to reprice aggressively. So, for example, you know, in scenario A, when you want to be aggressive, it's usually when you get, let's say, a rate cut that the market wasn't expecting, or you get some sort of stimulus announcement, or um, it could be literally anything. But as long as if the market hasn't priced it in at all, then that's where sometimes you just get these really huge moves really, really aggressively and really quickly. So if you hear something big, then you do need to be aggressive. That's how I see it, in my opinion. If you see something big and it's an announcement the market hasn't priced in, you need to be aggressive. As opposed to being passive, I think it's more when the market, from the top of my head, I'd say the best example is when the market's disappointed. So these kind of situations, when you're more passive, is kind of when the market's already priced something in and it's slowly getting disappointed. So let's say you go into a press conference, um, and the market is pricing in a lot of stimulus, and then you get to the press conference, and it seems as if either, if let's say you're watching the ECB and Draghi or whoever it may be speaking, starts having a pretty upbeat tone. You can hear that the way he's speaking, it's not as downbeat. He's not actually giving any hints of them doing some stimulus. You don't get anything from him. And he's starting to disappoint because the market was expecting something quite dovish. Slowly but surely, the market starts um, digesting an information, and the price action starts showing you that it's disappointed. But it's not a straightaway thing. You don't It's not a situation where you should get so aggressive so quickly, because there's still a lot of fluctuation. The market's waiting. There's a couple of punters thinking, okay, like still we could still, let's say, um, buy the bunds or buy the euro stocks here because we feel as if they could still say stimulus. But it's this time decay, and this, the longer the press conference goes and we don't get something out of that central banker, the market starts getting disappointed, and then you get quite an exacerbated move. So you know, in these kind of situations, in A, so what you would typically see um, in A is the market's kind of trading, it gets its information, and bang, you just get this huge move out of nowhere, and it's just, you could see it. If you look at a 5-minute chart, you can see it's very clearly something came out and it just exploded. Whereas in B, you're usually getting a market that's, let's say if they was disappointed, you're getting fluctuations, and then slowly but surely you start, um, well, it just slowly starts building in the price action. It's like it's not being able to find a bid. It can't find a bid. The offers start coming in, and then at some point the offers come in thick and fast, and the trend develops. It's more of a trend developing rather than um, a situation where some news comes out and then you get a huge move. So being able to wear that sort of price action. If you're selling, let's say here, you don't want to be selling your full clip here and then stopping out at this position here. You might want to actually sell a little bit more here, start massaging your position in. At this situation, you might start selling a little bit more here, a little bit more on the bounce here, and then the market comes lower. You might sell a little bit more. And overall, you're just bringing your average price down, yes, but you're slowly scaling it until you can see that the market's actually digesting the information before it moves. So in these kind of situations, it actually pays to be a bit passive. The aggressive approach, it always pays when you feel as if the market hasn't priced it in and it needs to move really, really quickly. So that's really what I wanted to cover for how you can actually execute the profitable price out of straight trades. For specifics on the price action, we'll take a look at that in the example. And the example we're going to go through is an ECB example from the beginning of this year, 2015 that is. I don't know when you might be hearing this, but we're looking at an example from the beginning of 2015. So stay tuned. There's still a lot to go through. The example will hopefully kind of bring everything together so you can see what I've been talking about so far. So thank you very much for listening and stay tuned, guys. Bye bye.